Hello and welcome everyone. Just for a minute, please. Yeah. Hello and welcome everyone. My name is Yasir Gulfraz and I'm your lecturer for Law for Accounting, Learning Outcomes to Understand Company and Insolvency Insolvency. So today we will be discussing company and insolvency law, specifically focusing on the formation, financing, and administration of companies, as well as the concept of insolvency. So anybody, if there is anyone, can you guys see my screen or can you hear my voice? If there is anyone there. Anybody there? Okay. So we will discuss about formation, financing, and administration of companies. So procedure of companies and limited liability partnership registration, including memorandum. Also today we will cover the procedure for company registration, the advantages and disadvantages of different legal structure, the concept of the veil of incorporation and the requirement of the Companies Act. We also explored the rules and responsibilities of directors, officers, and shareholders, along with the influence along with the influence of shareholders on a company. Finally, we discussed insolvency, including different types of liquidation, the right of creditors and employees, and personal insolvency. So any question in your mind, just do let me know, and then I will try to answer you. Okay. So what exactly company is? Anybody can tell me, if anyone is there, what company is? What is a company? Okay. Company is a legal entity with its own separate legal personality. This means that it exists independently from the individuals who own or manage it on a day-to-day basis. In other words, a company is treated as a separate person in the eyes of the law, distinct from its shareholders and directors. The separation of the company's legal personality from its owners and managers is often referred to as the veil of incorporation. So the veil of incorporation is a fundamental principle in company law, and it provides certain benefits and protections to both the company and its members. However, there are circumstances when this veil can be lifted, revealing the individuals behind the company. Any questions? Okay. So veil of incorporations and when it can be lifted. Nationality: in time of war, it is legal to trade with the enemy. It may be possible to lift the veil of incorporation so as it import to accompany the same nationality as its members. So one such circumstances is during the times of war, where trading with the enemies are prohibited. In these cases, a time may be possible to lift the veil of incorporation and attribute the same nationality to a company as its member. An example of this is the case of Daimler versus Continental Tire and Rubber Company in 1916. As you can see here, the facts were the defendant, a UK incorporated company, was owned by 5 individuals, and a company incorporated in Germany. Only one individual was British and he held the share. The claimants need not discharge their debts to the defendants, since effective control of the latter was in enemy hands, and hence to do so would be to trade with the enemy. So types of company. So let's talk about different types of companies. In general, we have two main categories. One is private companies and another one is public companies. So a private company is one that is privately owned and has restriction on the transfer of shares. On the other hand, a public limited company is typically larger and can offer its shares to the public, allowing anyone to become a shareholders. So here are private companies, public limited main differences between public and private companies. Secretary or company secretary must have one, must be qualified, normally a chartered accountant or member of ICAS, Institute of Chartered Institute of Company Secretaries. Need not have one, accounts must be audited, need one, not lay accounts before general meeting, must file with 9 months. Audit must file accounts within 6 months, audit not required if turnover below 6.5 million pounds, must be, is specifically talking about UK. So must be held each year, need not hold an annual general meeting, and can't pass written resolutions, can pass written resolutions. So any questions, please? Okay. Consequences of incorporation. When a company incorporates, it brings about several important consequences. Firstly, it enjoys limited liability. This means that if the company faces financial difficulties or fails, the shareholders' liability is limited to the amount unpaid on their shares or any agreed contributions, depending on whether the company is limited by shares or by guarantee. Additionally, a company can enter into contracts in its own name, sue and be sued in its own name, and own its own property. It also benefits from perpetual succession, meaning that the companies continues to exist even if the shareholders change over time. Furthermore, the management of a company is separate from its ownership, providing a clear distinctions between those who run the companies and those who own it. So in terms of legal requirements, companies are subject to the provisions outlined in the Companies Act 2006. This legislations govern various aspects of company formation, operations, and dissolutions, ensuring proper corporate governance and compliance. Here he's talking what is the rule in force versus Harbottle. It is a general principle of company law. This rule is fundamental principle in company law that states an individual shareholders cannot sue for wrongs done to the company or complain about internal irregularities. Instead of a company suffers an injury or wrongdoing, it is the company itself that must take appropriate legal action. Any questions so far? If anybody is there. Okay. Now he's talking about company law. Now we will be discussing an important topic in business and legal studies, which is company law. Company law refers to the set of law and regulations that governs the creation and operation of registered companies in the United Kingdom. The core body of company law primarily contained within the Companies Act 2006, along with the regulations and cases that clarify its application. Company law includes part of securities regulations and insolvency law. So company law encompasses various aspects, including securities regulations and insolvency law, to the extent that they apply to companies over the years. So each of these areas has involved into high developed legal subjects in their own rights. Corporate governance. Let's talk about the relationship between company law and corporate governance. Corporate governance, although not a legal term, focuses on how corporate decisions are made, by whom and for what purpose. So in many ways, corporate governance overlaps with the core company law, as it involves rules and principles that establish the lawful process and requirements for making corporate decisions. Various sources of company law. So moving on to the sources of company law, it draws from various acts and legislations governing companies. Some notable acts include the Company Acts 2006, Insolvency Act 1986, the Companies Director Disqualification Act 1986, the Financial Services and Market Act 2000, and then Criminal Justice Act Insider Dealing 1993, Companies Act 19, Company Investigations. Yeah, this is also called inside trading. So Company Audits, Investigations, and Community Enterprise Act 2004, Company Investigations and Community Interest Companies. So requirement of company law for the formation, financing, and administration of companies. The most common type of business entity in the UK is the private company limited by shares. Advantages of forming a company. Forming a company offers several advantages, including limited liability for owners and directors, ease of raising finance, and the ability to formalize ownership and voting arrangements. How to form a company. So how you go about forming a company, anyone can tell me if anyone is there? Okay, the process involves filling a series of documents with the registration of registrar of companies at company's house. Following the guidelines outlined in the Companies Act, the essential documents include Form INO1, and then which provides basic company information, the Memorandum of Association, and the Article of Association. Both will discuss in later in our chapter. So things to consider. When forming a company, there are several factors to consider. First, you need to choose an appropriate company name. The company complies with the legal requirements. For example, a private company name must end with the word limited, and it should not be too similar to the name of another existing company or infringe upon any trademarks. Shareholders and share capital. Another important aspect of determining the shareholders and share capital, a company must have at least one shareholder holding at least one share of nominal value, for example, 0.01. You may also consider creating different classes of shares to accommodate various rights and attract private investments. Directors. One of the most important company of any company is the board of director, which is comprised of those persons who carry out the day-to-day management of a company. So when forming a company, you will need to consider who to appoint as the initial director of the company in doing so. So the following consideration should be borne in mind. Minimum number of directors required to form a company is usually 2. There is no maximum permissible number of directors. So director who is an individual must be at least 16 years old. English law does not have any nationality or residence requirement in respect of directors. and also advisable to have directors and officers insurance in place to protect directors from claims of wrongdoing that could be personally liable on. So the board of directors plays a vital role in company management. When forming a company, you need to appoint the initial directors, ensuring compliance with certain requirements. For example, a minimum of 2 directors is usually required, and they must meet the age and eligibility criteria. It is also advisable to have directors and officers insurance in place to protect them from a potential claim. Next is a company secretary. While not mandatory for private companies, appointing a secretary can be beneficial to fulfill administrative requirements and avoid non-compliance with the Companies Act. The secretary can be an individual or another company, and they are responsible for maintaining minutes, books, and registers. Despite serving this duty from the company's perspective, a secretary can be a useful appointment in order to ensure the company's administrative requirements are met and that the company does not find itself in breach of the Companies Act. Registered office. So you must designate a registered office for the company. The registered office is the official address for the service of legal proceedings and other formal documents. It does not have to be the principal place of business, but should be located in England or Wales. Changing the registration office is possible through a board resolution and a form filed with Companies House. As a particular matter, it is often convenient that the secretary should be based on either at either the registered office or the principal place of business. So as I said, registered office can be easily changed at any time by a board resolution and a form which is filled Companies House, filed at Companies House. So constitutional documents. We need to address the constitutional documents of a company, namely the Memorandum of Association and Articles of Association. So anybody can tell me what difference between Memorandum of Association and Article of Associations, if anyone is there? Okay. Memorandum of Association and Article of Association. The Memorandum of Association is a standard form that states the intention of the initial stakeholders to form a company under the Companies Act. On the other hand, the Article of Association serves as a contract between the company and its shareholders, regulating various aspects such as dividend payments, director appointments, removal, share transfers, and the conduct of meeting. Any questions so far, if anyone is there? Okay. Just for a minute, please. Right. So Memorandum of Association is a standard form that states the intention of the initial shareholders to form a company under the Companies Act. So the Article of Association serves as a contract between the company and its shareholders, regulating various aspects such as dividend payments, director appointments, removal, share transfer, and the conduct of meetings. Article of Association. So the Article of Association are an important document that governs the internal affairs of a company and outlines its rules and regulations. So let's talk about some key points about Article of Association. So first of all, it's worth noting that Article of Association often incorporate the statutory model of articles, which are a predefined model article prescribed by regulations under the Companies Act. These model article can be amended to suit the specific needs of a company. If a company doesn't submit any other article of association, the unaltered form of the model article is automatically adopted. So now you may wonder why it's essential to consider the articles of association carefully. Well, this document plays a vital role in covering a wide range of subjects that are important for the company's operations and management. It can include provisions related to voting rights, dividend rights, terminations of directorships, and the sale of shares. For instance, if you have an equity investor involved, the article of association can ensure that you retain a majority of shareholders' votes despite having an equal number of shares. Analyze the role and responsibilities of company directors, officers, and shareholders. Under the Companies Act, anybody can tell me about analyze the role and responsibilities of, if anyone is there? Okay, under the Companies Act 2006, directors of UK limited companies have certain general duties imposed on them. The board of directors are responsible for managing the company's businesses, making strategies and operational decisions, and ensuring the company meets its statutory obligations. As an individual director, your role is to actively participate in board meetings, enabling the board to make informed decisions and fulfill the company's obligations. Directors act as agent of the company appointed by the shareholders to manage its day-to-day affairs. While the directors act collectively as a board, certain powers can be delegated to individual directors to committees. General duties of company's director. It is important to note that as a director, you may have also have additional rights and duties if you are a shareholder or an employee of the company. Normally, director responsibilities are, to promote the success of the company, exercise independent judgment, exercise reasonable care, skills, and diligence, avoid conflicts of interest, not to accept benefit from third parties, to declare interest, proposed transactions. So indirect responsibility can be done by an accountant, registering of business tax, VAT, pay pensions, filling annual confirmation statement, filling annual accounts with Companies House, filling company tax returns and annual companies account with the HMRC, reporting companies changes, registering for self assessments. Director can face also, they can also face disqualification and even imprisonment for serious offenses. So a company directors can also be held personally liability for act of omission committed during the course of their appointments. So it is important to understand that being a company director comes with a personal liability. Directors can be held personally liable for acts or omission committed during their appointments, including offenses such as unlawful discriminations, health and safety breaches, environmental breaches, or involvement in fraud, bribery, or money laundering. In some cases, directors can face disqualification and even imprisonment for serious offenses. So, talk about duties of shareholders of a company are effectively the company's financial supporters. They provide finance to a company by purchasing shares in the company and thus become shareholders and part owners of the company. So anybody can explain what rights do shareholders have? Anybody? Anyone is there? Okay. To attend general meetings and vote, to receive a share of the company's profit, to receive certain documents from company, to inspect statutory books and constitutional documents, to any final distribution on the winding up of the company. Duties of shareholders. Here the right duties of shareholders, and the main duty of shareholders is to pass resolution in general meetings by voting in their shareholders' capacity, as he is talking here. So this duty allows shareholders to exercise control over the company and its management. Voting can occur either through a show of hands or a poll vote, with the later being proportionate to the number of shares held. Ordinary resolution requires a simple majority of votes, while a special resolution may be necessary for important matters and typically require a 75% majority, as he discussed here as well. Explain the process of insolvency of business organizations. Insolvency for business organizations: when a company becomes financially unviable, outlives its unfulness, the process of a winding up or liquidating the companies take place. This involves ending the company's operations, selling the assets, and using the proceeds to repay outstanding debts. Insolvency law encompasses both insolvent and solvent companies. While the Insolvency Act 1986 primarily governs insolvent companies, winding ups, solvent winding ups are also covered to avoid duplication of provisions in both the Companies Act and the Insolvency Act. Insolvent company. Insolvent company is one that is unable to meet its financial obligations and is in a state of financial distress. The separation of insolvent companies winding up to provisions from company law legislations into specific insolvency legislations was a logical step taken in the mid-1980s. By considering the provision for winding up both solvent and insolvent companies, it eliminated duplications and streamlined the process. Additionally, it is essential to use the correct terminology, reserving the term bankruptcy for individual insolvency. So while insolvency applies to both companies and individuals, also, the last thing is the statutory order of distribution ensures that different types of creditors are paid in a specified priority sequence during the winding up process. Insolvency and administration. Insolvency process involves two key formal processes: administration, which aims to facilitate the resource uh, uh, rescue of facilitate the rescue of financial troubled companies, and liquidation, which involves winding up the company. So administration and liquidation have various powers during these process, including bringing legal actions and reviewing transactions entered into the company. Next is securities regulations and laws. If anybody can tell me. No one? Okay. Security regulations is an important aspect of financial law. The primary objectives of security law is to provide safeguards and protection to individuals who choose to invest their money in various financial instruments known as securities. It is worth noting that securities encompass a wide range of investment products, not limited to those associated with companies. Security regulation is an important aspect of financial law designed to provide protections to individuals who invest their money in securities. It encompasses the regulation of companies offering shares and bonds to the public, as well as the oversight of market where these investments are traded, by enforcing transparency, preventing misconduct, and safeguard investor interests. Securities regulations contributes to the stability and integrity of the financial market. Second is next is regulations, and next is global financial crisis of 2008. I believe that everyone heard that. So in 2008 and its impact on the financial system, UK financial system, the global financial crisis of 2008 had far-reaching consequences affecting economics around the world. In the UK, both UK and EU initiatives led to significant reforms in the regulations of banks and the realignment of regulatory responsibilities. One of the key changes was the enactment of the Financial Services Act 2012, which abolished the Financial Services Authority and established new regulatory bodies. Under the new framework, a micro-prudential authority called the Financial Policy Committee, FPC, was established. It oversees the Prudential Regulation Authority, which operates as a subsidiary of the Bank of England and the Financial Conduct Authority. These regulatory bodies have taken over the responsibilities previously held by the FCA, Financial Services Authority, in ensuring the stability and integrity of the UK financial system. While the regulations of security remained intact, the FCA was renamed and refocused, with some of its functions transferred to the PRA, or Prudential Prudential Society, PRA. Yeah, I don't know which page. Yeah, Prudential Regulation Authority. So the primary statute government securities regulation in the UK is Financial Services and Market Act 2000, which is also known as FSMA. It's here. So as amended by Financial Services Act 2012, detailed provisions governing securities can focused in the Financial Conduct Authority handbook, FCA handbook, which supplements the statutory provisions. In addition to the legal framework, there are also soft laws that plays a role in securities regulations. Example include the UK Corporate Governance Code and the Stewardship Code, which provide guidelines for corporate governance and responsible investment practices. Next one is advice on the insolvency process for a given situation. Insolvency is defined as a situation where a company or individual is unable to pay its debts. There are a number of reasons why a company might become insolves: loss of market, where companies have not recognized the need to change it in a shrinking or changing marketplace; management failure and fraud; loss of long-term finance, over gearing; lack of working capital, cash flow. Other reasons include excessive overheads, new ventures, expansion, acquisition. Next is insolvency case studies. Insolvency process and examine a case study scenario. In the given scenario, the client, a local supplier, which is C, and their customer, a manufacturing company, D, has failed to pay debts of 10,000 pound due to cash flow. So cash flow problems, the debts more than 30 days overdue, and there is no dispute regarding the underlying transactions. To address the apparent insolvency of the debtors, the client can take actions under the insolvency law of their country. The process typically involves initiating bankruptcy or liquidations proceeding against the debtor. So the goal is to obtain an effective final order, which means the debtor's affairs will be administered under the insolvency law. Analyze aspect of capital maintenance. The capital maintenance concept states that a profit should not be recognized unless a business has at least maintained the amount of its net assets during the accounting period. In simpler terms, profit is the increase is net assets during a period. However, it is important to note that inflation can distort the concept of capital maintenance. Inflationary pressures may increase net assets even if the underlying amount of assets has not changed. Therefore, adjusting net assets for the effects of inflation provide a more accurate picture of capital maintenance, especially in hyperinflationary environments. Any questions so far? Okay. In the context of limited companies, the shares capital serves as buffer fund of creditors. Rules on maintaining a capital prevent companies from reducing their capital by returning it to shareholders, except under certain circumstances. A reduction of capital can occur, for example, to cancel liabilities on partially paid shares, return capital in excess of the company needs, or cancel paid up capital no longer represented by assets. How an exceptions to this general rule: reduction of capital under section 641 Company Act 2006. A company reduces its capital at any time for any reason. Reduce or cancel liabilities, return capital is excess of the company's needs, cancel the paid up capital that is no longer represented by the assets. An interesting exception of the general rule in the conception of treasury shares. Treasury shares are created when a public company purchases its own shares from distribution profit. These shares can be held in treasury and reissued without the usual formation. So, however, there are specific rules and regulations regarding treasury shares, including limitations on vote rights, dividends, and distributions. Here I will talk about Global Financial Crisis 2008 promoted significant reforms in UK law. particularly in the regulation of banks and realignment of regulatory responsibilities. The insolvency process provides a legal framework for dealing with situations where companies or individuals are unable to pay their debts. A concept of capital maintenance ensures that a business recognizes profit only if it has maintained the net assets during an accounting period. And lately, treasury shares offer companies to liability to purchase and hold their own shares under certain conditions. So procedure of private companies pass specific resolutions supported by solvency statement. Solvency statement is statement by each of directors that the company will be able to meet its debtors within the following year, and then without responsible ground is an offense punishable by fine and imprisonment. Copies of the resolutions, insolvency statements, and a statement of capital must be filed the registered within 15 days. So there is some additional informations. Treasury shares, as I just discussed, that definitions created when a public company purchases its own shares from distributions profit. The shares do not have to cancel. Up to 10% of the shares can be held in treasury, which means they can be reissued without the usual formulations. General rules: shares which are purchased by a company must be cancelled and the amount of company's share capital account reduced by the nominal value of the cancelled shares. So exceptions: under section 2006, company listed on the stock exchange or the alternative investment market can buy, held or resell their shares. Under section 726 Company Act 2006, the shares will not given the companies any voting rights in respect of shares, those shares. In addition, no dividends or other form of distribution can be made in respect of them. Any consideration received on a sale of treasury share is to be treated as profit for distribution purpose. Under section 7 to 9 Company Acts 2006, in the event that shares are cancelled, there will be reduction in capital, but there is no need of a special resolution of the numbers of authorizations by the court. Section 730 Company Act states that where treasury shares are cancelled, the company must deliver a return to the registrar not later than 28 days. After the shares are cancelled, the return must state with respect of shares of each class cancelled. So the number and nominal value of the shares and the date on which they were cancelled. Notice must be accompanied by a statement of capital, which must state with respect of the company's shares capital immediately following the cancellations. Total number of shares of the company, aggregate nominal value of those shares. For each class of shares, prescribed particulars of the right attached to the shares, the total number of shares that class, the aggregate nominal value of shares of the class. The amount paid by and the amount, if any, unpaid for each shares, whether on account of the nominal value of the shares or by a way of premium. Treasury shares can also be created when a company initially issued shares to the public but keep a portion of its treasury to be sold at a later date. So here are some references. Plenary refers to ebook, journals, any queries. That's it. So that's it for today, guys. Any questions if anyone is there? Okay, this is our learning out session 2 of law of accounting, and it was session 2. So hopefully I'll see you guys next Sunday at Saturday and Sunday at 2 o'clock. So see you by then. So if there is any questions, please drop me an email at yasir@ukversity.co.uk, and have a good evening and bye for now.